Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit, and my name is Alex Matthew. This show gets you actionable insight to everything related to mutual funds. So whether it is the right portfolio to build or which scheme to choose, you'll find answers right here. And by the way, let's pull up that number on the screen if we possibly can. That's where you can send us your queries in case you've got questions on the mutual funds that you have or the ones that you intend to buy or invest in. And make sure to tell us your goals when you write in your questions so that we can address them with the knowledge of why you need the money. But on today's program, I want to focus on passive investing. Now, it's fairly discussed. We've had a fair amount of conversations about the usage of passive and how useful it is, but let's draw the line under how you should actually employ this strategy. And a lot of people have spoken about how it should be part of your core portfolio. We'll talk about that as well, the benefits of doing that. Vishal Jain, who's the Chief Executive Officer of Zerodha Fund House, is joining me on this conversation. Vishal, thanks so much for taking the time and pleasure having you. You are part of a fund house that has chosen to embrace passive wholeheartedly. So it's the only type of product that you offer. And I would think that's because you feel that that's a strong way to create wealth over the long term. Can you take us through the thinking as to why you only offer passive?
I think one of the large motivation factors for us to go the only passive way is to help increase penetration. So if you look at penetration at this point of time in the industry, we're touching approximately about 5 crore unique PAN folios in the industry. In our opinion, the penetration is quite limited at this point of time. And if you want the next 10, 15 crore guys to, to start using mutual fund products, to build better financial outcomes for themselves, then you need to introduce products which are very simple. And I think passive products are the ones that tick all those boxes. I mean, they're transparent, they're low cost, they're easy to understand. And I think that's the main objective why we have decided to use passive products, in our strategy.
The cost of oversimplifying this, I do want to mention, and of course, a lot of you tuning in on the various social media platforms and on television will know the difference between passive and active, but I'd like to keep this as open as possible and, reach out to as many people as possible. So very simply put, a passive strategy is where the fund manager does not choose individual stocks. The strategy simply mirrors an existing index. So if you've got questions, by the way, on that, you can write to us and we will simplify it further. But at this point, we assume that you know what we're talking about. Let's talk about whether or not this can form part of a core strategy. Vishal, I understand that your contention is that it very much can and should, but there are caveats here, right?
No, I think, why does one invest in equity? I think let's get back to that. I think I see two main reasons. One is that most of us are bullish about the country, and we want to sit on the India growth story. And the second thing is to beat inflation, right? And in the process of doing that, that's why we invest in equity. Why say a passive fund becomes an important piece of that pie is simply because it's a low cost, simple strategy for you to take exposure to the Indian markets. The biggest benefit of passive is the fact that whether it was 20 years back or whether it's 20 years ahead, right? You will always be invested in the best companies that are there in the Indian market, and it's a low cost and transparent strategy as compared to any other strategy that is there in the market. And therefore, a strategy like a passive strategy, a well-diversified basket is something that should form the core of your portfolio, right? And I always go and tell people that, look, there will always be times when you believe that there may be some other strategies which may generate better returns, but you can kind of build your portfolio in a core and satellite kind of a manner, where the core becomes becomes a main part of your strategy. That is, you want equity returns, and the satellite part, which is say the smaller part of your portfolio, is where you can actually take exposure to alternative strategies, right? And people can kind of use this approach in a very disciplined manner to be able to get benefit of both worlds actually.
Let's pull up some data because I asked my team to pull up some performance indicators, and we've basically looked at the 10-year performance of the passive category of mutual funds. And most of these are going to be either Nifty 50 funds or Nifty Next 50 funds or the Nifty 100 funds, because only off late you had the broader gauges being announced and launched. But the best performer is the Nippon Next 50 fund over the last 10-year period, 16.8% return. And the broader gauges have actually not necessarily beaten that. So the 100 ETF has actually done 13.7% or thereabouts. And we also have actively managed large cap fund performers, and we've looked at the top 10 or the top 5 performers here. The Nippon India large cap fund has made about 15.7% in that same period. Vishal, you pointed out that cost is a major factor here. In order to consistently outperform the passive and also the benchmark, you would have to have a differential of what, 1.5 percentage points for an actively managed fund, which is very hard to get, right, consistently?
Yeah. So if you look at most passively managed funds, whether they're ETFs or index funds, most of them range between 0.05% to about I would say 0.25 to 0.3% or so. Though TERs have come down on the active side. So on the large cap side, you will find that TERs have now come to 0.6, 0.7%. But on an average, most active funds have a TER ranging to about 1.25% or so, especially if you go towards the mid cap, flexi cap, and other categories that are there. Now, assume that there is a fund where your expense ratio is say 1%, and you have a passive fund which is say at 0.25%. Every year, 0.75% is what you are saving, or is the additional part of your funds that are getting invested in the market. Now look at it over a longer period of time. I mean, that 0.75% into 10 years becomes 7.5% of additional money, your money which is getting invested in the market. And that's how an expense ratio, a lower expense ratio, benefits investors in the long term.
I also want to point out the number of schemes that are currently offered. And after that, I have a quick question on when the outperformance takes place. Obviously, the most offered product is the Nifty 50 index, and 37 AMCs are currently offering it. 20 AMCs are offering the Nifty Next 50. The Sensex index fund is offered by 20. The Nifty Bank, there is an offer 13. And the Nifty Mid Cap 150 index is offered by 12. There are 2 or 3 that are offering the absolute broadest gauge, which is the 500 right now. And that is actually done reasonably well over the last 5 years. Vishal, I'm actually curious about what you have to say about this. Largely, it's been seen that the outperformance of a passive strategy takes place when there is a bull run, when there's a move upwards. The downside protection is always highlighted as a bit of a sticking point, and why maybe an active would score better than a passive. How do you balance that?
So I think your question or your statement is loaded in many ways. The first thing is you mentioned that Nifty 50 is where a lot of the schemes are. I'd like to highlight that if you looked at the Indian economy as a whole, you would find that all the way up to about 2013 to 2014 or so, you found that large caps are the ones that were kind of outperforming most of the segments of the market. Post 2014 is when the mid cap started doing well, and now people have actively started looking at the small cap. So therefore, you'll find that a lot of AUM is loaded towards the Nifty 50 because historically that's where the money has been invested in the Indian context, right? In terms of your question on whether in a downward market, passive, or an active strategy will outperform, very difficult to say, Alex. First is, how do you define, or when do you get to know that there's a downward market coming? It's only once it happens that you get to know. The second thing is, even if there are schemes that have outperformed, the benchmark, it's difficult for you to have picked the right scheme, right? And you will get to know only when you look at data, which is in hindsight. If somebody came and asked you that if the markets will fall, which is that one scheme, that one or two schemes that you should pick up in a downward market, it's very difficult for you to kind of pick and choose. And how do you pick and choose? I think that's the big question and dilemma that anybody has.
It's a fair point. But what about the point about now? Obviously, we've moved quite a far distance from 2014. Even over the last year, Vishal, I'm talking about actively managed, of course, because I was looking at that data the most recently. Maybe you can tell me about the passive assets under management. But active equity assets under management have risen by over 60% between September of last year and September of this year. There's an increase. Obviously, the underlying has also gone up, but a sizable amount of investment has taken place. Passive has also grown tremendously. What about the products that are currently being offered, though? And there are a lot of offers in the factor-based, in the smart beta, as they call it. What do you think about that as well?
So again, one thing about your first question in terms of growth of active versus passive. Remember one thing, Alex. Passive products are bought; they're not sold. Generally, when you look at it from any angle, whether you look at ETFs or whether you look at, say, even the index fund structure, um, typically distributors will tend to sell, I mean, products which have, higher distribution commissions, and passive products, because of their low TERs, will generally have lesser in terms for the distributor, right? And therefore, passive products are always products, and that's not only in India; it's across the globe where passive products are bought, they're not sold. So that's the first thing. The second thing is in terms of newer products coming into the market. Yes, there are. If you see the current trend, a lot of factor-based products, a lot of thematic products are coming into the market. But as I said, it's important for investors to be disciplined about their portfolios. Important to split your portfolio in a kind of core and satellite kind of an approach, where core, the larger part of your portfolio, you take exposure through a plain vanilla diversified index fund or an ETF. And the satellite part of your portfolio could be invested in any of these thematics or active funds, or any of these factor-based products, because any of these factor-based products or thematic products, nobody can tell when these products will do well, because different factors kind of move at different points of time. Different thematics or different sectors move at different points of time. You get back again to the question in terms of how do I pick the right fund manager, the right sector, the right stock. And in your whole quest of doing that, you end up losing the simple, pure market returns. And therefore, I would always suggest that a larger part of your portfolio should be through a plain vanilla, diversified, low cost ETF or an index fund. And the smaller part of the portfolio is which you can look at to investing in any of these other alternate strategies.
Point taken. And by the way, I only spoke about the growth in AUM of active because I remembered that data. I was looking at it. I'm sure that passive has also grown quite tremendously. I was looking at index funds, and they've grown quite tremendously over the last several months also, Vishal. So not to detract from that at all. But the last point that I want to ask you is, if we have established, and you have made a strong case for it, that the core should be passive, what product is the best, or should you have a combination of products? Nifty 50, of course, has been the traditionally sought out option, but as we've seen, there are certain other options that have actually done better.
I think it all depends on in terms of how clued in you are with your portfolio. If you're a person who's actively managing your portfolio, then you could have a combination of a Nifty 50, a Nifty Next 50, a Midcap 150, right, in the ratio that you want. If you're a person who likes a fillet shuttered kind of a portfolio, then one could just look at maybe a more diversified portfolio like a top 250, which has the top 250 companies in the index, or a Nifty 500, which will also have then small caps in it, right? So depending on your, I think, needs, and depending on how active you are managing your portfolio, or if you just want something simple, I mean, you could kind of take your pick.
It's a fair point. Vishal, thanks so much for joining in and for giving us that perspective and interesting conversation, to say the very least.
Thanks so much for inviting me, Alex. It was a pleasure.
My pleasure. All right, now let's take this conversation forward because I'm curious what Pankaj Matpal, who is the founder and chief executive officer of Optima Money Managers, has to say about this debate about the core allocation and how passive plays a part here. Pankaj, thanks so much for taking the time and welcome to the Mutual Fund Show. I don't know if you heard any parts of the conversation with Vishal, and what do you think about having the core allocation in your portfolio towards passive?
Thank you, Alex, for having me on the show. See, passive and active, both are good choices, and every investor can have both of them. So I'll not say that one is better than another one. But see, when we talk about core portfolio, if you want allocation large cap, we have seen that in large cap, index funds have been able to deliver better returns compared to even active funds. But if you talk about the mid cap, small cap, or flexi cap, this kind of funds, I'll say that active funds are a better choice. So, an investor portfolio, when you're deciding a portfolio within large cap, mid cap, small cap, so my suggestion would be that mid cap, small cap specifically, you should consider active funds. The reason is, see, it's not only returns, but also risk. In passive funds, index fund, the portfolio can be rebalanced every 6 months as per means the regulations or as per the standards, I mean. So, but if you talk about the active funds, if any point of time fund managers feel that a particular sector or particular segment has not been performing well and there's a need to change that, they can actively do that. So that is why I'll say that in portfolio you should have active funds, and specifically as I mentioned, for mid cap, small cap, it will be a better choice to have larger allocation in active funds.
No doubt. I don't disagree with that view, Pankaj. My question was about the core of the portfolio, because my understanding in a core and satellite allocation is you have a sizable chunk, you're talking about 40-50%, that forms the base of your portfolio, and the remaining 50% to 60% you can actually allocate to a small and mid cap. You can allocate towards some part towards thematic if you have 10 to 15%. And you can also have a flexi cap to take care of that. But the reason I was talking about the core allocation, simply from the perspective of reducing the volatility and the churn, and to have a consistent kind of a gain which allows you to form the base of your portfolio. Is that the right approach to have?
Alex, see, when we talk about core and satellite portfolio, see, my recommendation is around 20 to 30% allocation should be in satellite portfolio, and 80%, I'll say, in core portfolio. Now, as you mentioned, small cap should also be a part of your core portfolio. So ultimately, it's a diversified portfolio. Multiple sectors can be there in small cap, but allocation can be lesser compared to large cap, mid cap. So within that core portfolio, suppose 70% you're allocating in core portfolio, maybe that out of that 60% in large cap, 30% mid cap, 10% in small cap, something can be done. This satellite portfolio, 25%, 30% should be purely consist of thematic and sectoral funds. In themes also, we know many themes which are well diversified, like manufacturing theme, or it may be a infra theme, or sectors like banking sector or IT sector. So that 20-30% based on your risk appetite and your understanding about the market, because within the sector means you have to understand that you have to switch from one sector to another sector at the right time. So entry and exit is very important. But if you talk about large cap, mid cap, small cap, flexi cap, large and mid cap, multi cap, these all are diversified funds and should form a part of your core portfolio.
That's a fair point. All right. But let's talk about the large cap aspect of it. I'm just curious what you have to say about that and core. You've mentioned already that index funds have been able to beat the benchmark not the benchmark, sorry, I should correct myself, beat actively managed funds in the large cap category over the long term. Assuming that is the case, then I would think purely from the perspective of performance as well as cost, index funds or ETFs should be the pick. How would you choose between the two? Is there a cost advantage to choosing index funds over ETFs or ETFs over index funds, Pankaj?
Again, see, there are merits and demerits. See, if we talk about ETF, there is a real-time basis you can buy and sell those ETF. That is the one thing. But if you think about liquidity, see, if you talk about Nifty 50, I understand that there can be good liquidity, especially in Nifty Bs. But if you consider many other indices, you may not get liquidity. But when you invest in index fund or fund of funds, so you don't need to be worried about that, because ultimately you are selling through your fund house. So that is why it depends that what is the requirement and objective of investment. Second thing, if you want to do SIP, for example, in that case also index fund will be better choice, because you know that units can be bought as a fraction of unit. So that is why it makes better sense that if you invest 5,000 rupees per month, you can choose to invest through SIP in index funds. So if real time basis you want to buy, though I know that nobody does the trading in ETFs, so it is not a very big points. But yes, because price keeps on changing every moment during the market hours, so you can take advantage of that. But and second thing is, but otherwise, if you consider liquidity, you can consider ease of investment. I think that index funds can be a better choice.
Next one's a better choice. The last thought that I want you to comment on is the tracking error. How significant is this when you're choosing? Because a lot of people simply choose a scheme that they're familiar with, in a fund house that they're familiar with. But the tracking error can lead to a major underperformance vis-a-vis the benchmark over the long term. And here we're talking about 10 plus years usually. Pankaj, how important is tracking error?
Yes, Alex. Alex, before I explain this tracking error, your previous question, that cost-wise, the index versus ETF, I missed to answer that. Yes, index fund will be little more, will have more expense compared to ETF. That one has to keep in mind. But now,
the question that I was asking, Pankaj, is how much of a difference is it material?
Yeah, now coming to this index fund means your tracking error.
No,
Yes,
before
tracking
that,
errors-
Pankaj,
Okay.
you were saying that it's costlier, the index fund is costlier. Just to complete that point, it is costlier, but is there a sizable difference between ETF versus index fund?
See, Alex, it will depend from one to another, but difference cannot be very high. But yes, sometimes what happens that there are fund of funds which invest in ETF. So there's a ETF cost plus that fund management cost. It can be additional. But if it is directly index fund, the difference may not be very high.
Okay, let's
So that
go
is
ahead.
answer to previous question.
All right, let's talk about the tracking error now.
Yes. Now, see, tracking error is very important thing, no doubt about that. Some index funds have a tracking error of 0.01%, but at the same time, some have tracking error around 0.30%. So if you are seeing within the same category, 0.01 and 0.30%, it will be a big difference. See, again, depends that what is the size of portfolio, how much you're investing, and for how long you want to stay invested. Because longer the time horizon, the difference will be bigger. So that is why it is very, very important. One has to consider. But at the same time, along with tracking error, you have to see the liquidity, because there are some portfolios, some ETFs, I'll say, which become difficult. But if you're talking index fund, because we know that we transact through the AMC, so liquidity is not a concern. In that case, purely the lower the tracking error, better it is.
All right. We have time for a few questions, Pankaj. I'm taking the first one to you. Sneha Sarkar, who is 34 years old, says that she's accumulated 14 lakh rupees through 21,500 monthly SIPs and continuing with a 10% step up. She's open to investing for 16 more years. Her goal is to build a corpus of 5 crore rupees. It's a very substantial amount from where she's standing right now. Is she going in the right direction, though, is what she's asking. She's got the Nippon India focused equity scheme. She's got the Quant Active scheme. She's got the Motilal Oswal multi-cap, the Kotak small cap and the Tata small cap. She split her money between all of that. Pankaj, is this the right selection?
See, she has been investing for quite some time, and total portfolio size is, I think, 14 lakh rupees she has accumulated by now, 21,500 per month. So if we calculate at 12% CAGR, in next 16 years, she can accumulate around 2.97 crore. Her target is 5 crore. So there's a big difference. She'll have to almost double her SIP amount and then increase by 10% or little more than that. she'll be able to achieve her goal. As far as schemes are concerned, almost all schemes are good, but one suggestion, from Nippon India Focus Fund, she should switch to Nippon India Flexi Cap Fund. That will be a better choice considering her long-term investment horizon.
Okay, that's a fair point and a very pointed answer. Hariharan, who's 72 years old, Pankaj, is investing in more than 20 funds. He's trying to do asset allocation by eliminating duplication is what he's saying. He says he'll have to pay LTCG. He's invested for 12 years and have no specific goal in mind and no need for redemptions. Should he consolidate is a question. What are the suggestions?
See, definitely, if he switch from one scheme to another scheme, he has to pay long-term or short-term capital gain tax as applicable, though he has been investing for last 12 years. But suppose he has been investing through SIP route. So whatever he has invested in last 1 year will attract a short-term capital gain tax. But still, I'll say if he has 20 schemes in his portfolio, he must try to consolidate his portfolio and recalculate it. That is very, very important for better performance.
Last question, we have a minute. Shashi Kumar is asking a very pointed question. Axis Midcap, he's been investing for a period of 40 months with a horizon of 60 months. So he's got another 12 months to go. Or rather, actually, he's got a size of 20 months to go. The fund seems to have underperformed. Is it a good idea to switch to the Motilal Oswal Midcap Fund, which is a top performer right now, Pankaj?
I agree with him that he can switch from Axis Midcap to Motilal Oswal Midcap Fund. It will be a better choice.
Okay, all right. So it's a very quick answer. And thank you for that, Pankaj. And also, thank you so much for joining us on the Mutual Fund Show. It's been an absolute pleasure having you. And thank you so much for taking the time.
Thank you very much.
All right, that brings us to the end of this particular edition of the Mutual Fund Show. That number that you saw on your screen, that's where you send your questions to us. And we've got lots more coming up over the course of the day. This is NDTV Profit.